All right, welcome. We're about to dive into chapter 1 of what is truly a masterpiece, Benjamin Graham's The Intelligent Investor. We're going to break down the one critical difference between building real, lasting wealth and just gambling it all away.
So let's start with the absolute foundation. Graham lays it out right here, and he's incredibly specific. For something to be a real investment, it has to pass 3 tests. 1, you've done your homework, that's the thorough analysis. 2, it promises safety of principal, meaning you're not likely to lose your initial stake. And 3, it offers an adequate return. Notice he doesn't say a spectacular return, just an adequate one.
And this is the punchline. If what you're doing doesn't tick all 3 of those boxes, Graham says it's not a risky investment. No, it's something entirely different. It's speculation. And just knowing that difference, truly understanding it, is probably the most important thing you can do to protect your money long term. Okay, so let's get into the problem Graham saw so clearly. He warned that Wall Street just loves to blur these lines. Why? Well, it's good for business. They call everyone an investor, they make everything sound exciting, but that confusion can be absolutely disastrous for the average person.
Graham pointed out this kind of fascinating, totally backward logic that we all fall for. You know, when stocks are basically on sale, when prices are low, everyone gets scared. We call it risky. But then, when the market is flying high and prices are through the roof, that's when everyone feels safe to jump in, calling it a smart investment. It is the perfect recipe for buying high and selling low, every time.
So to help us avoid that trap, Graham lays out what he calls the 3 cardinal sins of speculation. First up, delusion. That's just fooling yourself, thinking you're investing when you're really just chasing a hot tip. Second, ignorance. This is when you speculate with serious money, but without the deep, expert-level knowledge you need to even have a chance. And the third, and this is the big one, risking money you absolutely cannot afford to lose, especially if you borrow.
Now, Graham's solution isn't to just run away from the stock market. Not at all. It's to know yourself. He gives us 2 very clear, very valid paths to follow. And the very first step is figuring out which of these paths is actually for you.
And this is the big question you have to ask yourself. Are you a defensive investor? You know, someone who values safety and simplicity above everything else. You want freedom from constant worry. Or are you an enterprising investor? Someone who's actually willing and able to put in the hard work, the research, the time to try and get better than average returns. There's no right answer here, just an honest one.
This image just captures the 2 mindsets perfectly. On the one hand, you've got the defensive investor, who's basically building a fortress to protect their capital. And on the other, you have what Graham called the enterprising investor. You'll sometimes see it called aggressive, like here, but the idea is the same. This is someone who's actively hunting for those hidden opportunities, digging through reports, and really trying to understand a business.
And for that defensive investor, the strategy it's beautifully simple. Graham suggested a basic 50-50 split, half in stocks, half in bonds. The magic is in rebalancing. So if your stocks have a great year and they grow to, say, 60% of your portfolio, you sell some of them and buy more bonds to get back to 50-50. It's an automatic system that forces you to sell high and buy low, and it takes all the emotion out of the decision.
And all of this leads to one of Graham's most profound ideas. He argued that success in investing, it has very little to do with your IQ. It has everything to do with your character and your discipline. And to prove this point, Graham's modern editor gives us the perfect example. Let's talk about Sir Isaac Newton. I mean, we're talking about one of the smartest people who has ever lived. If pure brain power was all it took to win at investing, he should have been the best in the world.
But he wasn't. Just look at this timeline. At first, Newton was super smart. He got into the South Sea Company stock, doubled his money, and cashed out. Smart move. But then, he had to sit there and watch his friends get even richer. The FOMO, the fear of missing out, it just became too much to handle. He tossed all his logic out the window, jumped back in at the absolute peak of the bubble, and lost a fortune.
And Newton's story just hammers the point home, right? Being a great investor is a trait of character, not of brain power. The real fight isn't you against the market. It's you against that emotional, follow-the-crowd instinct that lives inside all of us, the speculator on the left. The whole goal is to be the disciplined, analytical investor on the right.
So, the big question is, how do you actually manage those emotions? Well, Graham gives us this brilliant little mental tool, probably his most famous metaphor, to help you keep your cool. Let's meet him. So, Graham wants you to imagine that you're in business with a guy named Mr. Market. Every day, without fail, he shows up and makes you an offer. He'll either buy your share of the business or he'll sell you his. The only catch is, your partner is a total manic depressive. Some days, like you see on the left, he's absolutely euphoric. He thinks the future is amazing and offers to buy your shares for some ridiculously high price. But on other days, like on the right, he is just completely panicked. He's convinced the world is ending and offers to sell you his shares for pennies on the dollar.
Your job as the intelligent investor is to know how to deal with Mr. Market. You have to remember his moods are his problem, not yours. You are totally free to just ignore his quotes. But when he shows up depressed, offering you a crazy bargain, that's when you should buy. And when he's giddy and optimistic, offering you a silly price, that's when you should sell. You use his emotions. You don't let his emotions use you.
Okay, so let's tie all this together. What does this actually mean for you? It really all comes down to asking one simple question, which leads to the most important concept in the entire book. According to Graham, these are the two most important words in investing. Not what's the next big thing, not where's the market going, just how much. How much is this actual business worth, based on its real assets and its ability to earn money? Forcing yourself to answer that question anchors you to reality, not to Mr. Market's wild mood swings.
And asking how much leads you directly to Graham's biggest idea, the margin of safety. This is the absolute bedrock of intelligent investing. All it means is trying to buy $1's worth of a business for, say, 50 cents. That gap, that discount between the price you pay and the value you get, that is your protection against bad luck or being wrong. And that brings us to the final, most powerful lesson from this first chapter. The biggest risk you face as an investor? It's not a bad economy, and it's not a stock market crash. It's you. It's the person in the mirror. Mastering your own behavior is the real key to reaching your financial goals. So the question isn't what the market will do next, it's what will you do?